74 trading days. That is the number separating COMEX registered silver vaults from a figure that has never appeared on any institutional balance sheet in modern history. 0. Not stressed, not thin. Empty. While headlines cycle through oil prices and drone strikes, the physical metal underneath the entire paper futures market is leaving the vault system at a pace that no one on financial television is willing to quantify on camera. We are going to quantify it right now. Every number sourced, every line of math shown, no opinions dressed as data. Silver is at 84.40 on the bid as I record this. Start with what happened on Friday. 5 COMEX vaults, one direction, one session. Asahi, 169,300 ounces physically withdrawn. Not reclassified. Withdrawn. The metal left the exchange entirely. Brinks, 7 knives file of 150 ounces reclassified from registered to eligible. The silver stays in the building but exits the deliverable pool. It can no longer satisfy a futures contract. CNT, 532,446 ounces physically withdrawn. Gone. MTB, 2 movements same day. 1,284,642 ounces physically withdrawn. 450,644 ounces reclassified out of registered. MTB alone removed 1,743,286 ounces from the deliverable pool in a single session. StoneX, 531,345 ounces adjusted out of registered. Total registered change across 5 custodians in one Friday afternoon, 1,745,139 ounces removed from the deliverable pool. New registered total, 79,988,594 ounces. Below 80 million for the first time in this entire cycle, for context. COMEX registered peaked at approximately 240 million ounces in 2020. 2/3 of the deliverable silver that existed in this system 5 years ago is gone. The combined vault total, registered and eligible together, now stands at 346 million ounces, down from 532 million in October 2025. A 35% inventory decline in a commodity that takes 7 to 15 years to bring from mine discovery to first production. In January alone, 33.45 million ounces were pulled from registered vaults in a single week. That is 26% of the entire registered inventory. Gone in 5 trading days. February followed with the highest delivery volume in modern COMEX history for that month. March is on pace to exceed it with over 52 million ounces standing for delivery. Now plot that trajectory forward. The March contract still shows 1,281 contracts open. At 5,000 ounces per contract, that is 6.4 million ounces still potentially standing for delivery. And when March obligations complete, registered falls from 79.9 million to approximately 73.6 million ounces. Now attach May. 76,148 contracts open at Friday's close, multiply by 5,000 ounces per contract. 384.7 million ounces of paper obligation against a post-March registered vault of 73.6 million ounces. Paper to registered ratio, 5.2 to 1. Run 3 delivery scenarios, not predictions, subtraction. 10% of May contracts stand for delivery. 38.5 million ounces demanded. Registered falls to approximately 35 million before June. 20% stand. 76.9 million ounces demanded. That exceeds the entire post-March registered vault. Every deliverable ounce consumed and the obligation still is not met. 25% stand. A shortfall of 22.6 million ounces that the exchange must source from outside the registered pool entirely. The coverage ratio has already dropped below 14%. Below 15% is historically considered stressed territory, associated with delivery squeezes that force exchange intervention. We are past that line. At the current withdrawal pace, registered inventory reaches 0 in 74 trading days. That is not a projection built on speculation. That is the current rate plotted forward on the exchange's own published data. The only question is whether 74 days is accurate or too generous. Now cross to Shanghai, because the eastern half of this equation makes the western half look even more fragile. The Shanghai premium has been running between 13.5 and 14.6% above Western paper price for 6 consecutive readings, all trending higher. Shanghai's own silver inventory collapsed from 559 tons in November to 318.5 tons in February, a 43% decline in 3 months. A $13 premium between 2 connected exchanges should theoretically disappear within days. Buy in New York, ship to Shanghai. Collect the spread. Standard arbitrage. It is not closed. Here is why. As of January 1st, 2026, China reclassified silver as a strategic material. A new export licensing regime restricts silver exports to government-approved firms holding at least 80 tons of annual production capacity. That single requirement eliminated the majority of smaller producers and traders from the export pipeline. Metal now flows in one direction, west to east. The reverse route is legislated shut. The landed cost of Western silver entering China, accounting for the 13% value-added tax, shipping, insurance, and logistics, runs approximately $80 to $82 per ounce. No rational holder sells below the price at which a motivated buyer across the ocean will pay to receive it. The Shanghai premium is not an anomaly. It is the physical market broadcasting a structural floor price for Western silver, continuously, persistently, through a premium that arbitrage cannot close because the deliverable metal to execute that arbitrage does not exist in sufficient quantity, and the regulatory framework to reverse the flow has been deliberately removed. One more structural signal that mainstream coverage is not addressing. Silver is in backwardation. The spot price, the price for metal in hand right now, is trading above the futures price, the price for delivery months from now. In a functioning market, futures always trade above spot because storing and insuring metal over time costs money. When spot exceeds futures, the market is communicating something no analyst on television will say directly. Buyers want the metal now. They do not trust that it will be available later. Backwardation in silver is not a technical footnote on a chart. It is a structural alarm. And it has been sounding for weeks while paper continues to consolidate sideways. Now the part that separates this channel from hype. The risks are real, and you need to understand every one of them. If the Fed holds rates higher for longer and the dollar strengthens, that creates a genuine headwind for metals even in a war environment. Industrial demand destruction is real. Silver above $80 is forcing manufacturers to thrift, using less metal per unit. The Silver Institute expects industrial fabrication to decline roughly 2% in 2026, specifically because of cost-driven substitution. The CME has already hiked margins twice in 72 hours earlier this cycle. Silver margins jumped 36%. They can do it again without warning. And margin hikes force leveraged longs to liquidate regardless of thesis. If the Iran situation de-escalates and the strait reopens, the safe haven premium evaporates fast. A Chinese economic slowdown would cut industrial silver consumption at exactly the wrong moment. And JP Morgan has explicitly warned silver could crash to $50 if speculative positioning collapses. Every one of those risks is real. We do not wave them away. We factor them in. Your position sizing needs to account for every single one before you enter, not after. The complete picture on one table. COMEX registered silver, 79.9 million ounces. Post-March projection, 73.6 million. May open interest, 384.7 million ounces of paper obligation. Paper to registered ratio, 5.2 to 1. Coverage ratio, below 14%. Shanghai premium, 39 out of 14.6% across 6 readings. Shanghai inventory, down 43% in 3 months. Silver market status, backwardation, current pace to zero registered, 74 trading days. 4 independent data streams, 4 independent sources, 1 directional signal. But here is what that 74-day number does not account for. It assumes withdrawals continue at their current pace. It assumes the April delivery cycle does not accelerate. It assumes Shanghai does not push its premium above 15%. It assumes no additional margin hike forces paper liquidation while physical demand stays constant. Every single one of those assumptions is already under pressure. The question is not whether 74 days is accurate. The question is whether 74 days is too generous. April first notice day is now 12 days away. Watch how many contracts stand for delivery. If standing volume exceeds March, COMEX stress escalates immediately. Watch the Shanghai premium. If it breaks above 15%, that signals a new phase of Eastern accumulation that the Western paper market structurally cannot absorb. Watch the DXY. Above 100, the dollar is in a war-driven safe haven bid. Below 98, flows begin rotating fully into metals. The registered vault does not rebuild on its own. The Shanghai premium does not self-correct. The backwardation does not resolve, while physical metal continues leaving the system. 384.7 million ounces of paper against 73.6 million ounces of metal. The subtraction does not work, and subtraction does not negotiate. Verify every number. Pull the COMEX report. Check the Shanghai spot. Read the LBMA publication. That is the standard. That should always be the standard. This is Shadow Finance. We will see you tomorrow.